All right, welcome everyone to Module 7 of the FDIC Money Smart for Young Adults. Today's class is all about paying for college and cars. Specifically, this is about financing those things if you're going to use a loan for those things, but we will talk about some general principles about buying cars and paying for college that don't involve loans as well. So first we'll go over the post-test from last week. You guys all did really good on the test for last week. I'm getting really tired of this this test system that we have with sometimes they say select all that applies, sometimes they don't, and a lot of times multiple answers are correct. So for any of those that I feel like you guys got the right answer, just not all the right answers, I didn't mark those ones wrong. So some ones that a few people got wrong on. So number 5, these credit card solicitation tactics you should watch out for are A, B, and C, and that is important because those are red flags that they might be trying to get you into something that's not going to be good for you long term, like low or 0% introductory rates. An introductory rate is a rate that only lasts for a certain amount of time, and then they jack it up much higher. So you always want to watch out for that. Secondly, free products. If they're giving away things to get you to apply for this credit card, it's usually because the card by itself doesn't sell itself. You know what I mean? Like, it's not the greatest terms, so in order for them to get you to get it, they have to give you something for free. So that's a red flag that it might not be such a good card that you're applying for. And cashback bonuses, those can be good, but again, it kind of goes back to the free products. Does the cashback bonus justify the fees or the interest rate on the card? And then fixed APR, not really a red flag. That's just telling you what the interest rate's going to be on that card. So you just need to decide if you're happy with that rate or not. Another one was number 11. Which of the credit card terms below is most important to consider if you plan to pay off your balance each month? Now that's the key to answering this question correctly. If you plan to pay off your balance every month, why do you care what the APR is? You're never going to pay it. You're not going to pay any interest. It could have a 35% interest rate. It does not matter. You're never going to pay that as long as you pay that card off every month. Same with the late fee. The late fee only matters if you're going to be late. And the over the limit fee only matters if you're going to max out that credit card. The one thing that you do need to know, even if you plan to pay off that card every month, is the annual fee. You need to know if there is an annual fee and if so, how much, because that's a fee that everyone pays regardless of how you use that card. All right, and then number 12, which of the following are examples of using your credit card responsibly? The answer was A and D. Protecting your credit card and account numbers to prevent unauthorized use, and D, knowing the terms of your credit card. Someone circled C, paying interest on items when you could have waited and paid for them in cash. That's a terrible idea. Don't do that. Don't pay interest if you could pay the entire balance off by the first month and not pay interest. Like, there's no benefit to paying interest. All right, and I think that was it. Everything else you guys did really good on. Another thing I wanted to mention, it's kind of funny actually. This week, 2 of the things that we talked about last week happened to me personally. One, I got a credit card offer in the mail, and I showed it to my boys, and we looked at it, and it was a decent credit card offer. It was no annual fee. The interest rate was okay. There wasn't anything, horrible about this card, but it had 0 rewards. It had no rewards whatsoever. So I opted not to apply for that credit card because I like credit cards that pay me, that get rewards. So I'm not going to get a credit card that doesn't have any rewards attached to it when I can get other credit cards that do. Also, I was a victim of credit card fraud last week, in a sense. Someone used, actually it was my debit card that I never ever use, was used somewhere in Massachusetts for $256. Wasn't me. But I know that because I have text alerts on my phone. Anytime my card is used for any purchase over X amount of dollars, I get a text alert on my phone. which means every time I go grocery shopping, I get a text alert. Every time I get gas, I get a text alert. But I got a text alert at 11 o'clock at night, and it was someone using my card that I did not authorize. And so I have to call the bank and file a dispute and work through the process to get my money back, which you can do. You just need to know that that's an option and that you need to be watching your bank statements, your transaction histories, things like that, to make sure there aren't fraudsters using your card and spending your money for you. All right, now let's get into today's lesson. We'll start with the pre-test. Let's see. All right, question number 1. What is a secured loan? A loan in which you pledge collateral, something of value like a house or a car, to the lender. Correct. That is a secured loan versus an unsecured loan, which is a loan that has no collateral. Number 2, when you finance a car, the car then becomes blank for the loan. Collateral, right, exactly. Number 3, which of the following should you consider when deciding on whether to finance or lease a car?
All of the above.
All of the above. Wear and tear, monthly payment, and mileage limitations. We will get into that today. The pros and cons of leasing versus financing or getting a car loan. Number 4, what is the first step in applying for financial aid?
A.
No, financial advisors can't really tell you a whole lot about financial aid.
B. The one that's very, very specific.
That's right. Yeah, good multiple choice. The long one, letter B. Complete the free application for federal student aid, FAFSA. We'll talk about that too. Number 5, which of the following describe an installment loan? Select all that apply.
A and C.
Yep. It is A loan that is repaid in equal amounts, and C, a loan that must be repaid in a specific period of time. So remember, this is an installment loan, which is different from a line of credit. Lines of credit are variable, so that the amount may vary each month, and the amount of time is not a specific amount of time to pay it back. But a fixed installment loan is X amount of dollars for X amount of months. That's a fixed installment loan. Number 6, unsecured installment loans are generally used to pay for what?
D.
Sometimes. The correct answer, according to this guide, is B, education. And that is true. Student loans are unsecured loans. Normally, car loans are secured by the car, home loans are secured by the home, and furniture or computers purchased through store financing or rent-to-own services. Well, first off, rent-to-own, you don't actually own it in the first place. There is no security, per se. But if it's store financing, the furniture or computer will be the collateral for that loan. And if you don't pay it, they'll come and take your computer back. Although often, it is true that you can use unsecured loans to buy furniture and computers and stuff like that. I don't recommend that. I recommend saving up and paying cash for those kinds of things. Anyway, number 8. Which of the following refers to how you have paid bills and debts in the past? This is one of the 4 C's that lender used to determine whether to grant you for a loan. Which one is it? How you have paid bills or debts in the past.
We skipped 7.
Did I skip 7? I'm sorry. Number 7. Blank is the dollar amount the loan will cost, including interest, service charges, and loan fees.
A. APR.
Nope. APR is all of those numbers expressed as an annual rate. The actual dollar amount that the loan will cost, including interest, service charges, and loan fees, is the finance charge. Okay, now number 8. Which of the following refers to how you've paid bills or debts in the past?
C.
Character. That's right. What is your character? You have a character of someone who pays their debts on time. Number 9. Where can you obtain a car loan?
All of the
A, B,
above.
C, D, E.
Yeah.
Everywhere. All over the place. Yeah. banks, credit unions, car dealerships, finance companies, all over the place. Even on your Capital One app, according to the commercials I've been watching lately. Number 10, when comparing loans, you should choose the loan
B.
B with the lowest APR. That's right. Number 11, which of the following need to be paid back with interest after you finish or leave school?
C.
Federal student loans and non-federal. What's that?
What is even a federal work study?
We will get into that.
Oh.
That's part of the lesson for
Made
today.
up to me.
Nope, it's a real thing. It's a way to work through college. Number 12, which of the following might you receive if you fit a particular profile?
A.
A, scholarships. Yes. 13, in addition to tuition, what are some other costs associated with going to college?
A, B, C, D, E.
All the above.
All of it. College is expensive. Question?
Can you get a scholarship for just finishing high school with good grades?
With good grades, yes, there are academic scholarships. We'll get into that. That's part of the lesson for today. All right, last one, 14. What is a car title loan? Title loans. Title max.
C.
Check into cash.
C.
B.
It's actually B, a short-term loan that allows you to use your car as collateral.
Oh, now I understand.
It's a title loan.
Yeah.
So the difference between a title loan and a regular car loan is a car loan is typically used to purchase the car. A title loan is when you already own your car
And you're using the car
and
as
you're using it
collateral.
as collateral for a
Yeah.
different loan.
I see that.
Good. All right. You guys did really good on the pretest. You're probably going to fly through this stuff.
3 wrong.
All right. Let's get into it. So the objectives of the class today, we're going to talk about ways to differentiate between secured and unsecured installment loans. We're going to identify the factors lenders use to make loan decisions, identify the questions to ask when purchasing a car, and then describe various types of college loan programs. So college and cars. All right, skip the cartoon. Cartoon's great, but whatever. Installment loans. So installment loans are money you borrow and repay in a fixed monthly payments or installations over a set period of time, usually several years. I gotta get a drink. So I feel like we've already covered that, right? You guys understand fixed installment loans. Okay, there are two types of fixed installment loans: secured fixed installment loans and unsecured fixed installment loans. A secured loan has collateral, an asset that you own, like your car or your house, and you have to give it to the lender if you can't repay the loan. And in the loan contract that you sign when you buy said car is, if you miss X number of payments, they repossess your car. They come and they take your car back from you, and they sell the car in order to pay back the loan. Unsecured loans are not secured by collateral. These are considered higher risk because the lender can't really do anything about it if you don't pay. They can trash your credit, tell the credit bureaus that, hey, you're irresponsible and don't pay your bills and you won't be able to get any other loans. They can call you every single day and say, where's my money? Where's my money? Where's my money? They can even sue you and try to get wages garnished or your bank accounts frozen or things like that. But if you don't have any money, they're out of luck. So unsecured loans are slightly higher risk, and usually that means higher fees, higher interest rates for unsecured loans. All right, we're not going to do activity 1. Cost terms related to installment loans. So you have the annual percentage rate, which is for installment loans. You have, well, I guess we should talk about the other ones before we talk about the APR. It makes more sense. So you have a fixed rate loan, which is the interest rate does not change, right? It starts at 10%, it ends at 10%. It's a 10% loan. Variable rate loan, the rate can change over time. Most of the time, variable rate loans are like credit cards that are tied to prime rate, variable interest rates. There are also fixed loans that can have variable interest rates, and you just need to read the terms of whatever loan product you're reading because they can change and those terms change. Like a good example of this is adjustable rate mortgages. An adjustable rate mortgage is fixed for a certain amount of time, typically 5 to 7 years, and then after that, it adjusts based on market rate at that time. So, like right now, for example, those are actually getting more popular because the interest rates are higher. They'll give you a low introductory interest rate on your mortgage, but in 5 years, if interest rates are higher, your interest rate will go up. And vice versa, if interest rates are lower, it'll go down. So you just need to be aware of that and what you're getting into. The finance charge is the dollar amount of all the interest you're gonna pay, all the fees, origination fees, processing fees, application fees, whatever, all of that expressed as a dollar amount. And it'll be the total amount of interest that you pay over the entire life of the loan. This is a great way to compare different loan offerings because it takes into account whether it's a 5-year loan or an 8-year loan or whatever, along with all of the fees attached to it. And then the annual percentage rate is that number expressed as an annual percentage rate. So they're kind of similar, but they're not the same. One's a dollar amount, one's a rate. All right, the 4 C's again. Reviewing this, capacity is your capacity to pay back the loan, like your income, how much money you make, your present and future ability to meet your payment obligations. Capital refers to the value of your assets and your net worth. Do you have money set aside for emergencies and things like that? Character, how you've paid your bills and debts in the past. Typically this is expressed on your credit report. And then collateral, property or assets used to secure the loan. Now, collateral and capital are often thought to be the same thing, but the difference is the collateral is actually security for the loan. Capital is just other assets you have in general that really help with like unsecured loans, so the lender knows you're not, $3 away from being bankrupt. And if you lose your job, you'll have assets that you can sell in order to pay the loan, things like that. All right, we're gonna skip that one too. Car loans. There are some helpful information on the government website, the Federal Trade Commission publications. They have some different publications that you can read that are kind of beneficial. The main thing you need to know is to finance a car, you have to, A, be at least 18 or have a cosigner who's at least 18 and have sufficient income to pay back the loan. It's pretty basic, but there you go. Okay, car loans versus car leases. Hands down, far and above everything else, the best way to buy a car is to pay cash for it. But if you can't, if you don't have enough money, or if the particular car that you have to have is just a little bit more expensive than the amount you have in savings, you can look at either a car loan or a car lease. Now, a car loan is pretty straightforward. You borrow whatever amount you don't have, your down payment. You borrow whatever amount you don't have in order to buy the car, and you pay back that loan in X amount of months at X amount of interest rate. It's a fixed, secured installment loan, right? A lease is really kind of similar to those rent-to-own things that we talked about a few weeks ago. It's the same kind of thing. You're renting a car with an option to buy. That's what a car lease is. So there is a chart that looks like this in your book. I don't know what page it's on. Somebody tell me what page that is. 14? Page 14, where it has a breakdown of the differences between car loans and car leases. So we're going to go through this a little bit. Ownership potential. For car loans, the car belongs to you and the bank that gave you the loan until you have paid off the loan. Once you've paid off the loan, the bank releases their lien on that car and you own it free and clear. Car leases are different. You're basically renting the car from the dealership. It's a rental agreement where you pay monthly payments for a set number of months. The car does not belong to you. When the lease ends, you have to give the car back But you do have an option to purchase the car at the end of the lease. So when you're signing your lease agreement, they'll have all this stuff spelled out. You rent the car for this amount of time. Sometimes they still require a down payment, and there's a monthly lease cost. And at the end of the lease, here's how much we'll sell you the car for at that point. Now, a lot of times what you'll find is the car might be worth that much at that point, might not. You may be overpaying for a car. Question?
I was gonna say, is it more expensive to do that?
It is when you count all those payments you already made, when you could have just bought the car in the first place. Wear and tear. There are no additional costs for wear and tear in your loan agreement. If you buy a car and it wears and tears, that's your problem. The bank does not care. Leases charge you extra for any damage found at the end of the lease that goes beyond normal wear and tear. You get a scratch on it, something like that. They're going to charge you for that.
What happens if you total the car?
Then you have to buy them a new car.
You can't just purchase that car?
Do you want to buy a totaled car?
No.
Me neither. All right, monthly payments. So car loans, typically the payments are higher, but you only pay them for a set term, then you own the car. Leases generally have a lower payment because you don't actually own the car, you're renting it. So month to month, rentals or leases sound good because you can get the same car for $50 a month less or something like that. Yeah.
Are there different things, like you can rent it for like 6 months or 1 month or 2 months or something?
If you're only renting a car for a month, you might be better off going to like an actual car rental place, like Hertz Rental or Budget Rental, things like that. Leasing a car is usually at least a year, typically 3 years. Auto insurance. It is usually less expensive than auto insurance for leased cars for car loans. So for a car loan, your insurance company is going to require, or actually your loan company, the bank that's giving you the loan to buy your car, they're going to require you to carry comprehensive and collision coverage on that car up to the value of the car. Because if you total it, as Logan said, if you total it, they want their loan paid off, right? So if you carry just that amount of coverage, that's fine, and that's the least expensive option. But just know, if you total that car, you don't have a car anymore. But you also don't have the car loan anymore. So, good and bad. Leases usually cost more for auto insurance because most car leases require you to carry higher levels of coverage than purchase agreements. And also, some insurance carriers may consider leasing to be higher risk than purchasing. All right, and then cost. So long term, buying a car with a loan is going to be cheaper than renting or leasing the car. Short term, the lease will probably cost less because your total loan amount and monthly payments are likely to be lower. However, if you exceed the mileage on a leased car, they have mileage restrictions. You can only drive it so far and put so much wear and tear on this vehicle. Otherwise, they will charge you more for overusing your leased or rented vehicle. Yeah.
So why do people even do that in the first place?
I'm not really sure. Because every time I've looked at the numbers of leasing a car versus buying a car, even with a car loan, it doesn't make sense. It doesn't. But people still do it. Maybe because the monthly expense is lower and they're just not paying attention to all the other fees that they're paying. And I suppose if you're a specific type of person that is okay paying car payments your entire life without fail, because with a car loan, you get a 4-year car loan, you pay it off. If you own the car longer than 4 years, you don't have a car payment anymore, right? Well, with leasing, what some people will do is they'll lease a car for that 3-year term, give it back, and lease another one. And that way, they get brand new to 3-year-old car their whole life and just pay that monthly payment every month. So it works for some people. if you've got that kind of money and are okay paying car payments your entire life.
Yeah, but then you have to watch out for accidents, like damages that probably just left you have to buy a whole new
Yeah.
car.
So you have to pay extra insurance. Yeah. Leah,
But if you have that kind of money, why don't you just buy the car?
that's a good question.
I was gonna say, people who usually lease, they keep moving around. That's why they are forced to lease, because you can't buy a car in every single state you live in. For like
Sure you can.
3 months.
You drive the car to the other state,
I know, but like, what if you don't want to drive that far?
I suppose. Or you could just sell your car and buy another one when you get there.
But that would take a lot of work and stuff.
Maybe. Maybe. So, pros and cons. Just the important thing to note is compare your options, run the math, see what's going to make sense for you in your situation. We'll skip this activity too. All right. Total cost of a car. So you have the loan portion of it. Let's say you're buying a car. Do I have other numbers in here? I think I do. Okay. Here's a little scenario for you guys. So, you decide to buy a used car and you have saved $2,500 from your summer jobs for a down payment. You find a car you like, the monthly payment is $225 for 60 months with your $2,500 down payment. The tax and registration fee is $575 and the APR is 12.1%. So first off, extra costs when you go to buy a car. First thing is sales tax. You have to pay sales tax when you buy a car. That is the single biggest expense that you never think about when you go to buy the car. Because you think, I've got $2,500, I can go buy a $2,500 car. No, you can't. You can buy a $2,000 car, and the extra $500 will be used up in tax, registration fees, license fees, all kinds of extra things that are involved when you go to buy a car. So sales tax is a big one. Title and registration fees, typically like $100 or so. And also, if you're buying a car from a dealership, there's also extra things they try to sell you. Things like extended car warranties. This is a big one. Dealerships love their extended car warranties. Now, this isn't part of the lesson here, but I'm just telling you guys this because it's something you got to watch out for. A warranty, a car warranty, is basically an insurance policy against your car breaking down. So your car insurance does not help you if your car breaks down. Car insurance only helps if you get hit or you hit something. Weather-related stuff too, like if you get hail damage on your car and you have all the little divots on your hood and stuff like that. Insurance will cover those kinds of things. Insurance does not cover if your battery dies. Does not cover if your radiator leaks. Does not cover if your transmission fails. Any of that kind of stuff. Insurance doesn't cover that. You have to pay for that. You have to fix that stuff on your own. And it really stinks when you have a car payment and your car isn't even running. I've known people that are still making payments on a car that doesn't even run. That's a bad place to be. So, car companies sell car warranties. So a car warranty is basically, hey, if you take good care of your car, get your regular oil changes, do all the stuff you're supposed to do, preventative maintenance type stuff, if your car breaks down, we'll pay to fix it. Now, car warranty sounds like a great idea. Here's the thing. Oftentimes, as with most other kinds of insurance, there's all these specific things you have to have done, like getting your oil changes done on time and all this kind of stuff. And if you didn't do that, well, we're not paying for it. You didn't do your preventative maintenance. Also, there's typically a deductible. The deductible may be $100 and maybe $500. How many car repairs can you fix for $100 to $500? Most of them, right? That warranty didn't do you any good. Thirdly, these car warranties can be very expensive. A typical car warranty costs anywhere from $1,000 to $4,000. You're practically prepaying that big car expense that you may or may not even have. So, in my experience, most of the time, car warranties financially don't make sense. What does make sense is saving your money and having an emergency fund ready to go if a car repair event does happen. Because most of the time, you can get that car repair fixed for less than the cost of that warranty in the first place. A warranty only really makes sense if you fully expect to have multiple high-cost repairs on that vehicle within the time frame of that warranty, which is usually only a year to 2 years. If you're buying a car and you fully expect the transmission to go out in the next year, don't buy that car. Buy a different one. So, anyway, that was kind of a tangent, but a good one. All right. So, working out the numbers here. So you can see here you have the loan payment itself, $225 a month for 60 months is $13,500, plus the down payment that you're paying, the $2,500 from your summer job, and the tax and registration fee. The total amount you're paying for this car is $16,575. This is an important calculation to run through before you decide to buy a car, because you may be really surprised with the total cost. So just make sure that you're running these numbers before you buy a car. Don't get sucked into just the monthly payment. Car dealership salesmen have a reputation for being the kind of guys that will slickly get you excited about the car, and they're just like, here, sign here, it's only $225 a month, no problem. And you sign it, and you didn't read the fine print, you didn't run the numbers, and you end up later like, why did I do that? I just overpaid by thousands of dollars. Happens a lot, especially if they sneak in extended warranties and things like that. All right, where to obtain car loans? You can get them pretty much anywhere. Your bank is the best place to start. So a lot of, like I was just saying, those car dealerships, the car salesmen are often kind of, I don't know, sleazy, I guess is a way to describe them. A good way to make sure that they're not trying to trick you or sell you anything extra that you didn't ask for is to get your financing somewhere else, like your bank or a credit union, where you have your financing ready to go and you are a cash buyer at the dealership, where you can talk about concrete numbers. I want to buy this car for $10,000, this car for $12,000. Extended warranty raises the cost to $13,000. No, I don't want that. You know, things like that. It's concrete terms, as opposed to, well, this car is $200 a month, this car is $225 a month. You know, for an extra $10 a month, we can throw you in an extended warranty. $10 a month for 3 years, that's almost $4,000. Yeah.
What's the average cost amount for a car that just runs? Like, it's not fancy anything, it just runs.
That really depends. It really depends. You need to do your own research on that, because my idea of a car that runs well might be different than your idea of a car that runs well. There are different people out there with different preferences on this kind of thing. Like, what year is your truck?
It's in 1986.
1986. But you've rebuilt that thing like from the ground up, right?
Yeah.
So you put a lot of initial investment into that truck, but you've got that truck fixed up, and as the saying goes, they don't make them like they used to, right? That thing's probably going to run for 10 years without you having to do anything else to it. Maybe not that long, but a long time.
Yeah.
So you could go that route. You could go kind of the extreme of getting a cheap vehicle and just fixing everything in it, and it'll last you a long time. And you probably don't need to get a car loan for something like that. Or you can go the other way. You buy a brand new car, you're paying $30,000, but that car probably isn't going to have any repairs for 10 years, right? If you do your regular oil changes and stuff like that, you shouldn't have to pay any extra repair costs or anything. And there's a whole measure in between, and it really just depends. And you never know. You could buy a car that's less than 10 years old, less than 100,000 miles, which is a common baseline for a reliable car, and the transmission will still go out. It's just blind luck. You never know. So you just need to come up with what makes sense for you. What can you afford, and what's a reliable vehicle? There are some things you can take into consideration, like sedans, 4-door cars, generally are just plain cheaper than 2-door sports cars or trucks or SUVs. Those are just more expensive in general. And they're better on gas too. So, anyway. So, other places you can get a car loan from, you can get financing at the dealership. So here's the pros and cons. You generally, like, there's 4 options on here, but banks, credit unions, and finance companies are kind of the same kind of thing. You know, it's getting your financing before you go to the dealership, which is good because you can compete like a cash buyer and know exactly what you're getting into at the dealership. However, if you don't want to go through all the time and effort and exercise of calling 3 different banks and a credit union and a finance company and shopping around loan terms, car dealerships do that for you, supposedly. Different dealerships have finance departments that will actually shop for you, and they'll shop 20 different lenders. So theoretically, they might be giving you the best deal right there. But sometimes they're not. So here's the thing, and I don't know if I'm getting ahead of myself or not. Let's see. Okay, yeah, so I already said that. Okay, so financing through the dealership. The thing with financing through a dealership is, one, they can shop around several different lenders for you automatically. It's really nice. However, depending on the dealership, depending on how, honest they are, which you don't know that, sometimes they won't give you the best loan terms for you. They'll give you the best loan terms for them. What I mean by that is that finance companies make partnerships with car dealerships where they will actually pay that car dealership a percentage, like a commission, for giving people their loans versus another bank's loans. So let's say I'm a car dealership and I'm selling, used cars, whatever. And you come to me and I run your credit and I check my 10 different lenders that I partner with. And I've got, loan terms anything from 10% to 15%. And the 10% one will pay me $100 to do a loan with them. The 15% one will pay me $500 to do a loan with them. As a car dealership, which one do you think I'm going to try to get you to sign up with? I'm going to try to get you to sign up for the 15% car loan because I get $500, right? So if you go to a dealership and try to get financing, just be really careful, know your terms. It's probably better to shop around and do your financing ahead of time. Yep, that's what we just said. Okay. All right, switching gears. Now let's talk about student loans. Oh no, hang on, one more thing. Car title loans. Title loans. You've probably seen ads out there for title loans, title loan companies. So these are kind of in the same category as payday lenders, except they're secured payday loans. They're secured by your car. So a title loan, there's an activity for this. Here, let's read this activity. Activity number 5, beware of car title loans. All right, so it's on page 24 of your participant guide. So here's the scenario. Michael had $500 in unexpected medical expenses and needed a loan. He saw a TV commercial that declared if you have a car, you can get a loan. Michael had a car that was worth about $2,500, so he decided to apply for the loan. The finance company Michael saw in the commercial loaned him $500 at 20% interest per month. Note that the finance company did not advertise the APR. The finance company took his car title as collateral, and Michael kept the car. With a 20% monthly interest rate on the $500 loan, Michael owed $600 at the end of the month. the $500 he borrowed, plus $100 in interest. Michael couldn't pay the $600 at the end of the month. The lender could have repossessed the car. However, the lender was nice and gave Michael the option of just paying the $100 interest and gave him until next month to pay the loan. At the end of the next month, Michael still owed $600. $500 amount that he borrowed, plus another $100 in interest. Still couldn't pay it back. By the end of 1 year, Michael had paid $1,200 in interest for this $500 loan. This equates to a loan with a 240% APR. See how that works? Finally, Michael received a bonus from work and was able to pay off the $600. What could Michael have done differently?
Done more research.
Read the terms of what he was doing. Maybe get a loan from somewhere else that didn't have 240% interest rate. Here's another thing specific to this example. Medical expenses. Never, ever, ever get a loan for medical expenses. Now, dental work and things that they require you to prepay for, if it's something that you need done, you might need to get a loan for that. But if you went to the doctor, you hurt yourself, got in a car accident, broke your leg, whatever it was, and you go to the doctor and you get fixed up, and then they send you those medical bills. Those medical bills can be thousands upon thousands of dollars. And you will be tempted, I can't pay this, I need to go get a loan in order to pay these expenses. Never ever do that. Here's why. Medical providers will work with you to figure out a payment plan to pay off your medical expenses. And if you are quick to call them and work with them and get on some kind of payment plan or something, it won't even show up on your credit report. It will never become a collection. Question?
Do those hospital things charge interest? If you miss
No, they don't. That's why you never get a loan for it. Medical bills don't charge interest. So why would you get a loan and pay interest on something you could have just made payments on without any interest? Don't do that. It's crazy. Never, ever, ever get a loan to pay off medical bills. Don't do it. All right. Now let's talk about student loans. How to pay for college. Show of hands, who in here actually plans on going to college? Like 4-year degree, normal college? Anybody? Some of you maybe. Maybe some of you are thinking maybe more like a trade school or something like that. Or maybe some of you, I ain't doing college. Whatever. There's also another option that I highly recommend, military. Military is great. If you can join the military, you can serve like a 2 or 4-year term in the military. They will pay your college. You do the military first, then you go to college, and the military pays all your college, and you don't pay a dime. And then you get out of college, and not only do you have 4 years of working experience with the military, which is good by itself, but you also have a college degree. And you didn't pay for any of it. In fact, they paid you. Military is a great option. But if military is not an option for you, and you want to go to college, here is the order of things you need to do, in order. First thing, apply for financial aid, federal student aid, Pell Grants, student loans, college work-study programs. The first one especially, grants and scholarships. Grants, scholarships, and financial aid are the things you should do first, before anything else. Before just going and paying for college, you should do this. This is the very first thing you should do. Look at, because these federal grants, a grant is money they give you. You don't pay it back. It's not a loan. It's, here's free money. Why would you not take that? Take it. Free grants. Same with scholarships. Scholarships, there are tons of scholarships out there for all kinds of different things. There are scholarships for good grades. There are scholarships for people in certain demographics. There are scholarships for people with different historical backgrounds. You know, there are scholarships for people who are descendants of Scandinavia. You know, whatever. Like, there's all kinds of weird scholarships out there for all kinds of different things. There's athletic scholarships. There's all kinds of scholarships. But you do have to be careful with these scholarships because a lot of times they're restricted on where you can go to school. Like a lot of schools will give you an academic or sports scholarship only at their school. So you need to like compare that, you know. So like if you're a really good athlete, for example, you might get offers from 3 different schools for athletic scholarships, and you need to compare how much of a scholarship are they giving you and how much does the tuition cost at that school. Because one thing you'll find out is most scholarships are not free ride scholarships. Free ride scholarships is everything's paid for. Those are very few and far between. A lot of times these scholarships are like $5,000, $10,000, something like that. That might pay for a semester of school. So, but you can combine multiple scholarships together in some cases. Maybe you've got an academic and an athletic scholarship. Maybe you've got another one too for some demographic that you met or criteria that you met or whatever. And you can get the Pell Grant, which is a government grant of free money for people going to college. You know, things like that. If you go to a college, when you submit your like initial enrollment application for that college, you'll talk to a counselor who will guide you through all this kind of stuff in more detail. This class is just kind of a high level overview of all this, so you kind of have an idea of what to expect. Tips to getting aid include applying early, like months before the school year actually starts. Read the instructions, file electronically. You can submit paper forms and mail them to them. We call that snail mail, and it takes a lot longer to look at that. So if you can do it electronically, do it electronically. Complete tax returns. They will want to see tax returns to look at your income. They'll probably also want your parents' tax returns because your parents' income is a big factor in a lot of financial aid and grants and things like that. Scholarships. Oh yeah, I forgot about scholarship scams. So one thing you should definitely do, and that's well worth your time, is when you are looking at going into college, spend some time looking for scholarships. Like Google, school scholarships, and just there's all kinds of resources out there. There's all kinds of different scholarships out there, and they're all over the place. There's all these little small organizations that offer scholarships, and you never know which ones you might fit the criteria for. And it's free money, so it's worth taking the time to look for those. If you spend 2 days scouring the internet all day long for 2 days, and you find one $5,000 scholarship, was it worthwhile? You made $5,000 in 2 days. Yeah, it's worth it. But watch out for scholarship scams. There are scholarship scams out there that aren't real scholarships, but they look really good, and they say, oh, this scholarship is for everyone whose name is Jake. And if your name is Jake, you get $5,000. Just submit a $150 application fee. If they're asking you for money to process your application, probably not real. So beware of that. All right? All right. Potential grant programs. There's the federal Pell Grants, Federal Supplemental Education Opportunity Grant. Yeah. I don't want to go through all this stuff because this class is 12 years old. Some of these might not even exist anymore. I'll just let you guys know there are tons of grants, tons of scholarship options out there. Work with your school counselor, your enrollment counselor, or whatever they call it, whatever school you want to go to, and they will help you sift through all this stuff. And just spend time on your own researching scholarships and finding what scholarships are out there for you and your particular situation. All right. So, in the order of how you should pay for college, you have number 1, federal financial student aid, grants, scholarships, etc., free money, right? Second, pay for it yourself. work your way through school, get a part-time job, whatever. Last, when all else fails, student loans. Student loans are getting a lot of media attention because so many people are so steep in student loan debt. Student loan debt is huge, partly because people don't understand how loans work, which is what this class is for, and partly because people spent thousands upon thousands of dollars getting these college degrees that are worthless. You can spend 4 years of your life spending $30,000 per year between your tuition, your books, your living expenses, everything, and you can get student loans to cover all that stuff, and you can get a 4-year degree in liberal arts, which will get you absolutely nowhere when you're trying to find a job. The kind of jobs that hire you with a liberal arts degree are the same kind of jobs that hire people with no college degree at all. Except you happen to be carrying $30,000 times 4, which is $120,000 worth of student loans. That's a bad place to be. So, I don't know if I'm getting ahead of myself on this, but another thing to think about is where you're going to go to school and what you're going to go to school for are very important considerations. Try to focus on getting a degree that's actually going to get you a decent job out there in the real world. And you can also start your general ed classes, like in a 4-year degree. You have a question?
Do most colleges offer the same type of, well, I know that some colleges do specific things, but don't they also do other side scholarships that you can do?
So you have a scholarship
Not
question?
scholarships, degrees.
Degrees are different everywhere you go. Everywhere you go, they're going to have different degree programs and different varying qualities of degree programs out there. Like, I hear people tell me all the time that there are certain schools you go to if you want to be an engineer, there are other schools you want to go to if you want to be a nurse. You know, so it just kind of depends on what field you're interested in, which is a good place to start. Don't just go to college for the sake of going to college. Have a field in mind, a work field, and get a college degree that relates to that field. Some fields require you to get college degrees, like nursing and engineering, for example. You have to get a college degree in that field in order to get a job in that field. So if that's what you want, that's what you have to go for. Now, other jobs are kind of more vague. If you don't know what you want to do with your life, but you know you want to be in the business field somewhere, an MBA is a good option, a Master's of Business Administration. It's a good kind of catch-all kind of degree that covers lots of things in the financial field. So if you wanted to, you know, do something in finance, but you don't know what, or something in like an office setting, desk job, that's a good option to go to for something like that. Lost my train of thought. So assuming you've done all your homework, you've kind of figured out what type of field you want to go into. Oh, I was going to say, a lot of times if you're going for like a 4-year degree, like a bachelor's degree, a lot of times there's regular educational criteria that you have to finish before you start taking specialized classes for whatever degree you're going for. Those can usually be done a lot cheaper at like a community college. So you don't have to go to Mizzou right away. You could go to St. Charles County Community College, where classes are less than half the cost of going to Mizzou, and you can live with your parents for free and go there. So you can cut down that cost substantially by doing your first couple of years of gen ed classes at a community college versus doing all of them at a 4-year university or something like that. So that's another way to cut down cost and lessen the amount of money that you need to borrow with these student loans. So now let's get into the student loans themselves. So number one, as with everything else, do your homework. Ask questions, compare loan options. Complete the FAFSA. The FAFSA is an application that your college, enrollment coordinator, counselor, whatever you want to call it, is going to have you fill that out like the very first thing. And that's going to get you your Pell Grants, your federal student aid, and any federal student loans that you can get, which federal student loans are way better than private student loans. So that's an important thing to remember. that there are federal student loans, which are government backed, and then there are private student loans, which are from banks and financial institutions or whatever. Federal student loans are better for a variety of reasons. One, they typically have lower interest rates than private student loans. And two, they often have really favorable terms. Like a lot of them can be forgiven after a certain amount of time if you meet certain criteria. As in you don't have to pay them back at all, which is really nice. So you want to pay attention to that and read into that and see how you could potentially take advantage of it. There's a huge variety of federal student loans. For the sake of time and the fact that this again is a 12-year-old class, so some of this may have changed, we're not going to get into the details of all these different types of federal student loans. Just know that there are a variety of them out there and that you need to do your homework and compare loan offerings and figure out what's going to be the best fit for you. One important difference between student loans and every other kind of loan is that student loans, you borrow the money before you go to college, right? Because you have to pay your tuition and your books and your living expenses while you're in college. Well, most people who are in college aren't working. So, student loans you don't have to make any payments while you're in school. So you can get this student loan, have this student loan for 4 years while you're in college, never making a single payment on it. And then you can start making payments on it once you graduate. And a lot of these have even a time limit even after you graduate before you have to start making the payments on it. Like this Federal Perkins loan, 9 months. Direct Stafford loan, 6 months. Some of them no grace period. As soon as you graduate, boom, you gotta start making loan payments. Now, this is great because you're in college. You're a poor college kid, right? You have no money, maybe you work a part-time job, but you don't really wanna be making these student loan payments while you're in college. However, just because you're not making payments on it doesn't mean they aren't charging you interest. So what happens is those entire 4 years that you're in school, you borrow this much, it's gonna go like this. Every year, the amount that you're gonna have to pay back. The longer you're in school, the more you're gonna have to pay back because you're not making any payments on it to keep that down or to even start paying it off. So keep that in mind. Let's see, what else? Consolidation, not really talking about that. And that goes for both federal student loans and private student loans. You have that option to do that. So you kind of need to see what's prudent about that. Oh, also another thing, because of that, you don't necessarily want to borrow your entire college expenses right then. A good practice is to only borrow what you need for that semester. And you can do this. You can get a student loan at semester 1, and then get another student loan at semester 2, and then another one at semester 3. Because what you're doing there is you're starting the clock at where that interest starts to accrue later. If you borrow your entire 4 years of college expenses on year 1, you're charging interest on that whole thing from year 1, when you don't actually need that money until year 2 and year 3. So get your student loans in sections. Get just what you need right then. Sometimes if you are smart and you plan ahead and you did your research with Pell Grants and scholarships and working summer jobs to help pay for it and all that kind of stuff, you can sometimes get a couple of years in before you even need to do student loans. And then once you do, start borrowing just a little bit at a time, just what you need to get through. And then as soon as you graduate, start paying those things off. All right. Private student loans basically work the same way as federal student loans, except they don't have the option to forgive or anything like that. They do require a credit check. Sometimes they need a cosigner. Sometimes your parents need to be on there with you, things like that. And they often have higher rates and higher fees. So that's like the last option. So again, in order, from the top, grants and scholarships and financial aid, free money. Number 1. 2, pay for it yourself. Get summer jobs, maybe your parents will help you out, whatever it is, pay for it yourself. After you've exhausted both of those options, federal student loans. And after the federal student loans run out, and they won't give you any more, private student loans is the last option. All right? So in that order, free money first, pay for it yourself, federal student loans, private student loans. In that order. All right? Federal work study program. So work study program, there's a variety of versions of these out there, and sometimes they're kind of degree specific. Think like internships. Internships is a type of work study program. This is a way for you to work through college, and again, this is another one of those things where you just need to kind of do your research and compare the options out there. There are some general ones. Some schools will just hire you to work at the school, maybe in the library or in the lunchroom or whatever it is, and they'll pay you to work there, and they'll give you some kind of credit towards paying for your schooling. Other ones are more internship based, like let's say you're going to be a nurse. Maybe you're going to school to be a nurse. You can do an internship at the hospital, doing menial tasks for the other nurses, getting job experience and getting paid, and they pay some of your tuition for you. Things like that. So those are a good way to go about. That's a really good way to extend that second part, paying for it yourself, right? Maybe look at those before you look at student loans and see what options there are. Costs of college. In your book, there is a page that has a little, it almost looks like a little budgeting form. That's because that's what it is. It's like this. This is a good idea for you and maybe your parents along with you to work through this as you're planning on. This honestly is beneficial even if you're not going to college. If you're just wanting to move out, this is a good exercise to go through with your parents to kind of figure out what kind of expenses you're going to have. Now, this chart is mainly to be used as an annual calculation. So you're going to be thinking about your education expenses for the whole year, your tuition, your books, your fees, all that stuff, transportation costs, housing costs, room and board, food costs. So you have column A is all your expenses for the whole year, and then column B is your income for the whole year. You have family contribution, what money you expect to make, work jobs, grants, scholarships, all that kind of stuff, student loans, whatever it is. This is a good exercise to work through to kind of plan out what your first year of college or moving out on your own might look like. So, highly recommend going through that exercise. All right. Any questions about anything? No? All right. That's it. So we have gone over all about buying cars and paying for college. Hope this class has been beneficial for you guys, and we'll see you next time.